Hey everybody, John Duncan here. I want to give you a quick education on qualified accounts. If you are a high earner and you are still stuffing your qualified account full of money, this will be an important lesson for you. It's unfortunate, but even a lot of CPAs are still recommending qualified accounts for higher income earners. So with that, let's get started. You can see what I've got in front of me is the history of taxation. And you can see I put in an account balance of $1 million. And on the side here, I can actually move up and down the tax rate. And back when the 401ks and qualified type accounts were started, you can see that the tax rate back then was 70%. It was 70%. You can see where it's at today. Now, we're not counting state tax, which can be substantial as well, especially in places like California. But back up here, 70% was the maximum tax rate. And when you defer taxes, because that's all a qualified account will do is defer taxes. What you're doing is two things. You're deferring the tax, and number two, you're deferring the tax calculation. And as you can see by this chart, tax rates can change at any point in time. Now, if you look here, one of the issues that if you go back into 2007, 2008, when people had to go get money out of their 401ks and so forth, not only did they pay the tax, they also paid a penalty. So you can see here, if you had to pull all of it out or a good portion out, your tax rate can be high as well as you have a 10% penalty on top of what you withdraw. Now, the problem I have with qualified accounts for high income people that are building large scale assets is one of the three pillars of wealth is advanced tax strategy. And advanced tax strategy for someone that's growing assets means that you're looking at ways to reduce taxes now and going forward, not potentially increase them. We have a government that is spending $1 trillion that they'll admit to over what they're taking in right now. And this is a great economy. So the potential for higher tax rates in the future is definitely strong. And you can see, go back up here to the 70%. At that point in time, the gamble was that at some point rate would go down or you retire and have a lower income. And here's the deal. That worked out for those folks back then. Now, the opposite could be true. What's interesting is if you show the average here is 57%. If it just went back, and the average is from 1913 to 2018. Check that out. $1 million in the account, cash out 430. The other side of the coin is when people die and there's an account left or money left inside their qualified account, a lot of times the children will cash that account out. The money is added to your children's income for that year. And a lot of times it's the highest tax bracket. So there are multiple other ways and I'll talk about them on a different get together. But there are multiple ways to achieve the same result of reducing tax cost. But instead of simply deferring the tax cost and kicking it down the road, there are ways to actually eliminate the tax, which eliminates this huge problem. Because it's interesting to me, I mean, very smart people that make a lot of money that I work with all the time, they open up their statement and see a big balance in their 401k or in their defined benefit or whatever, and they have no clue that about half that money is either the federal government or state government. I mean, it's a taxable, that all that's happened is they've deferred a bunch of money that the government has control over how much they get down the road. And I don't know about you, but I don't like the government having control over what I own going down the road. So obviously they are the elephant in the room, and it just still shocks me that so many CPAs still recommend funding to the max your 401k or your defined benefit. It makes absolutely no sense for high net worth, high income individuals. If in fact you have funded the heck out of your 401k or IRA, there are some very intelligent ways to offset some of that taxation as you convert either to a Roth or whatever. So again, I'll cover that on another video that I put together. So anywho, bottom line is beware of putting too much money into qualified accounts, because you are gambling that tax rates will stay where they are and not go up again. And number two, even if they stayed the same, you're going to eventually pay taxes, not only what you deferred, but also on any growth. Taxes will be due. And I'm not suggesting not seeking tax advantage, but the qualified plan for the high income, high net worth client is not a good place to look. So with that, this is John Duncan. Thank you.